Ramsey, and today's version of the weekly blog series is on the most basic fundamental saving strategies that we walk clients through. Now this is mainly geared towards our younger clients or the clients that are in the wealth accumulation phase of life. So we're going to be talking about pre-tax and post-tax savings buckets. If you haven't seen that video, you might want to go back and check it out. We explain what pre-tax versus post-tax savings accounts look like. But on the pre-tax side, the most common one we see clients use is a 401k. 401k, 403b, simple IRA, and really we refer to these as company-sponsored retirement plans. Now most folks, what we find is their contribution limits are really whatever the match is. So for example, if we have a client that's putting in 6% of their pay to their company-sponsored retirement plan, it's more often than not that clients put in 6% because they're getting matched by the company up to 6%. And so that's a basic rule that we find that clients sort of follow. Now, one thing that we encourage clients to do every year, and most people get raises throughout, year over year. So what we encourage clients to do is to increase their contribution limits by 1% a year, or 1% every other year. Now, in their paycheck, we show them throughout the planning process that by them contributing 1% more a year, it doesn't have a huge impact on their paycheck, and so most people can just sustain that additional 1% giving. And most of that's covered by the raise that they got. So most people get 2 or 3% in a raise, and they defer 1% more into their company sponsored retirement plan. So they still get a bit of a raise, but the impact is not that great, especially when you're talking only 1%. And so the other saving strategy we have is contributing to a post-tax account. Now there's a number of different type of accounts that are in that post-tax savings. We're not going to get into those today. Those are in future episodes or in episodes we've already had. But on the post-tax side, again, this is a scenario where we walk clients through cash flow planning, and we identify money at the end of the month that the client really could be saving if they wanted to. And so what we encourage clients to do is to take some percentage, some dollar amount every month and transfer it automatically or systematically to an investment account. Now the reason we do that is because studies have shown over the years that if money stays in a checking account, people spend it. And that's okay. But if you systematically move money from a checking account over to an investment account, the more likely that client is to accumulate wealth. And so that's what we encourage clients to do. Now at the end of the year, we've accumulated some money, and now we're looking to distribute that money to whatever account type that we find most appropriate. So those are the two most fundamental basic ways of saving strategies that we encourage clients to consider. Number one, increasing their contribution to their company's sponsored retirement plan by 1% either every year or every other year, depending on how often you get raises. And then two, allot some dollar amount every month to be transferred from your checking account into an investment account. So if you've got any other questions about that strategy or any other strategy, feel free to give us a call. Make sure you tune back into our podcast series where we go into a lot more detail around the different types of pre-tax savings accounts and post-tax savings accounts. But today we just wanted to give you an idea of the two most fundamental principles of saving and what they look like and what we encourage to walk clients through. But thanks for watching, and we'll catch you next time.